Good evening. In financial markets tonight, the silver futures market is drawing significant attention from analysts and independent researchers as a critical deadline approaches. Tomorrow marks the March silver first notice day on the COMEX exchange, and the latest inventory data is revealing a substantial gap between the volume of paper claims outstanding and the physical silver actually available for delivery. According to the most recent CME Daily Silver Stocks report, reflecting figures as of the February 25th close, registered silver on the COMEX stands at exactly 86,130,399 ounces, approximately 87 million ounces when rounded. Registered silver refers specifically to the portion of inventory that is certified and immediately eligible to be delivered against active futures contracts. This figure is distinct from the broader category of eligible silver, which must undergo an additional process before it qualifies for delivery. Set against that 87 million ounce figure is an open interest position in the March contract, equivalent to approximately 529 million ounces of paper claims. That represents roughly 105,800 active contracts, each representing 5,000 ounces of silver. The resulting ratio stands at approximately 6 paper claims for every 1 registered ounce currently sitting in COMEX vaults. Adding further weight to this data point, the previous trading session alone saw a net withdrawal from registered inventory of 152,455 ounces, with total withdrawals on that single day reaching 1,270,768 ounces against receipts of just 65,032 ounces. Researchers note that registered silver has declined approximately 57% from a recent peak near 200 million ounces. Total COMEX silver inventory, combining both registered and eligible categories, stands at approximately 360.6 million ounces. However, independent researchers emphasize that it is the registered portion alone that is immediately available to satisfy futures delivery obligations, and it is that figure which has drawn the most scrutiny heading into tomorrow's deadline. First notice day is the date on which short sellers in the futures market are required to formally notify long position holders of their intent to deliver physical metal. Long holders who wish to receive actual silver rather than roll their contracts forward or accept cash settlement must formally stand for delivery. The delivery process that follows involves assignment, warrant issuance, and the movement of metal from registered status to deliverable status. March is considered a major delivery month in the silver futures calendar, which accounts for the structurally higher open interest compared to minor contract months. Researchers point out that under normal market conditions, the majority of futures contracts are either rolled forward into subsequent months or settled in cash, with only a small percentage resulting in physical delivery. However, when registered inventories are at historically low levels relative to outstanding paper claims, the incentive structure for long holders to stand for physical delivery increases. Independent market observers have calculated that if just 20% of current long position holders were to stand for delivery on the March contract, the resulting demand would exceed 100 million ounces, a figure already larger than the current registered inventory of approximately 87 million ounces. A significant factor in the current market dynamic is the price differential between Western and Eastern silver markets. Western spot silver closed at $32.88 per ounce. On the Shanghai Gold Exchange, the equivalent price reached approximately $99.50 per ounce in United States dollar terms. That represents a premium of $10.70 per ounce, or more than 12% above the Western quoted price. Intraday price movements pushed that premium as high as $12.15, with reports of Shanghai Gold Exchange prices briefly touching the equivalent of $14 above Western levels at peak moments during the session. The Shanghai Gold Exchange quotes silver prices in Chinese yuan per kilogram. Researchers applying the conversion using the February 25th AM fix of 22,121 yuan per kilogram, a spot exchange rate of approximately 6.85 yuan per United States dollar, and the standard conversion factor of 32.1507 troy ounces per kilogram, arrived at the approximately $99.50 per ounce figure. Multiple independent tracking sources confirmed premiums ranging from $10.19 to $12.15 throughout the trading session. Researchers describe this price differential as creating an arbitrage incentive in which buyers acquire silver through Western markets at the lower quoted price, arrange for shipment to Shanghai exchange warehouses, and retain the margin after accounting for freight, insurance, and refining costs. Each ounce removed from COMEX vaults for export purposes reduces the registered inventory category further. The 1,270,768 ounce single-day withdrawal, recorded in the most recent report, has been characterized by independent researchers as likely connected, at least in part, to this eastbound flow of physical metal. Turning now to additional developments that researchers have flagged in connection with the current silver market situation. On February 25th Eastern Time, as the Shanghai premium was reportedly approaching $15 per ounce, and Shanghai gold exchange prices reached the equivalent of approximately $104, the COMEX Globex electronic trading platform experienced a trading halt. The exchange cited a data center cooling failure as the official cause of the interruption. Researchers observing the market at the time noted that the halt occurred at a moment when Western prices would, under normal conditions, have been expected to adjust upward in response to the signals being generated by physical market activity in the East. Following the conclusion of the halt, Western spot silver prices declined by approximately $4 per ounce. During the outage itself, observers recorded a volume spike of approximately 31,000 contracts alongside a noticeable decline in open interest. No major macroeconomic data releases, including consumer price index figures or Federal Reserve statements, were reported on that date to account for the price movement. The narratives that circulated in markets following the halt referenced reported progress in United States and Iran nuclear discussions, which was characterized as reducing safe haven demand, as well as January personal consumption expenditures data, suggesting the Federal Reserve would maintain its current policy stance. Independent researchers describe these as cover narratives, stating that the primary driver of market activity was the physical arbitrage dynamic and the ongoing vault inventory decline, rather than the cited geopolitical or monetary policy developments. In broader context, the COMEX is identified as the world's largest silver futures trading venue and serves as the benchmark price reference for miners, jewelers, solar manufacturers, and exchange-traded fund administrators globally. Researchers have also noted that SLV, a major silver exchange-traded fund, has at times reflected premiums and discounts that do not precisely track the Western spot price, a condition they attribute to the challenges of sourcing physical silver at quoted Western prices, while Eastern buyers continue to pay significantly higher rates. To summarize the full scope of the data at the center of this report, registered silver on the COMEX stands at 86,130,399 ounces, approximately 87 million ounces. The single-day withdrawal figure recorded in the most recent report reached 1,270,768 ounces, with a net registered change of negative 152,455 ounces. Total COMEX inventory across both registered and eligible categories sits at approximately 360.6 million ounces. The March contract open interest represents approximately 529 million ounces in paper claims. Western spot silver is quoted at $32.88 per ounce, while the Shanghai Gold Exchange equivalent stands at approximately $99.50, reflecting a premium of $10.70, with intraday spikes reaching $12.15 and reported peaks near the $14 level. The February 25th trading halt on COMEX Globex, the $4 price decline that followed its conclusion, and the 31,000 contract volume spike recorded during the interruption round out the key data points researchers have identified as significant in the current environment. Independent researchers monitoring the silver market have emphasized that the COMEX exchange retains a range of tools available to manage delivery situations, including cash settlement options and contractual provisions for extraordinary circumstances. The focus of forensic market observers at this time is on the measurable and verifiable data contained in the daily CME vault reports, the open interest figures, and the ongoing price differential between Eastern and Western physical silver markets. Observers have stated that they will be watching closely for the delivery standing figures expected to be released by late afternoon or early evening Eastern Time on February 27th, as well as subsequent daily vault reports for any further changes to the registered inventory category. This broadcast has presented the publicly available data as reported and as interpreted by independent market researchers. The figures cited originate from CME Group daily silver stocks reports and publicly available exchange rate data. As with all financial market reporting, viewers are encouraged to consult the primary source documents directly and to seek qualified professional guidance before drawing conclusions relevant to any personal financial decisions. This is a news report only and does not constitute financial, investment, or trading advice of any kind. That is the full report on the March Silver First Notice Day and the current state of COMEX registered silver inventories. We will continue to monitor this developing story as new data becomes available. Good evening.